Hey traders, what's up? Do you guys want to make your trading less stressful and have higher probability trades and be more certain in your trades? Well, this video is just for you. How was that for clickbait? Do you guys enjoy that? So let's just get right into this. The only 4 qualifiers you're going to need to get into a trade in any market, right? Any asset that you trade, these are going to be 4 qualifiers that you can take on a day-by-day basis, right, to get into trades with a higher probability of profitability. And I want you guys to smash that like button, hit that subscribe button, and ring that little bell to notify you when we drop videos like these and go live. Realistically, trading is a stressful aspect, and there's a lot of uncertainty in the actual action itself, right? There's a lot of uncertainty in, am I getting into the right trade? Am I doing the right thing? Am I getting out at the right time? Am I doing the right thing is often the biggest question, right? There's a lot of lacking confidence in their trading abilities if you don't know what you need to know. So the only 4 qualifiers that you guys will need and understand in any market, right, no matter what you're trading, are going to be number 1, market structure. Number 2, levels of interest. Number 3, volume. And number 4, risk management. So these are going to be the main things that encompass your trading and your trades. So whether you're swing trading, whether you're day trading, these 4 concepts are going to be the concepts that you have to break down to, 1, get into a trade, get out of a trade, right? These are your qualifiers, so let's jump right into this. Now, I'm going to be using the SPY naturally as my friend, right? My number 1 friend in the market, right? When it comes to options trading. We can use AMD, we can use anything. We can swing trade, we can day trade, whatever the case may be. We're going to go through a few different examples. With the SPY, we have this main screen, but what if I go to a different screen here where we can start fresh, realistically? Talk about the Airbnb trades that we made today. We'll talk about other different things. So let's do Airbnb and SPY together. So first things first, right? We're going to be talking about market structure. Generally, market structure is how price action moves, right? We have talked about this many a time before. In a bullish market, we have higher highs, higher lows. In a bearish market, lower lows, lower highs. A range is a range where we have equal of both highs and lows. So understanding the market structure can lead you to understand what direction you should be playing in, realistically. So with that, what we can see leading up to this in the SPY, we have higher highs and higher lows, right? Theoretically, higher highs, higher lows. We're doing really well until at one point that structure breaks. So how does a structure break? Number 1, if we print a new lower high in a bull market, it just reverses for the bear market. I don't want to go through both of them necessarily that much, but if you just reverse whatever I say for the bull into the bear, you'll have a great concept. So for example, if we get a lower high in the bull market, that's step number 1 to disqualify that this is going to be a continued trend. In a bear market, if we get a higher low, right, then that starts to disqualify that we're in that bear. So let's take an example here. Step number 1, do we get the lower high? Yes, we do. Do we get, right, the break of the impulse area or the prior higher low? Yes, we do. That confirms the transition into what we have now, which is a downward market. So do we have a higher low here? Yes, technically this was news driven, right? We do have a higher low. Have we broken the prior, right, lower high? We have technically, right? We could still move a little up. So is this a turn in the market? Maybe, right? We don't know for sure unless we get a massive increase based on volume, another one of our qualifiers. And you can see volume is terrible on this way up. So what we're looking at right now is the market structure of this general market. Theoretically, we are in a bear market right now. We are in a bearish move, bearish trend. So we're going to be looking for lower lows and lower highs on a market structure perspective, right? You apply this to any time frame that you're looking at. We can look for a small tide shift very soon though, right? Is this the bottom? Probably not, but we can look for a small tide shift very soon. So if we go to the hourly chart on this, same principles, right? We're going to do the same thing. Let's look at the hourly here. So we look at the hourly, and the hourly all of a sudden, right, it looks more like a range, right? But in the most recent sphere here, higher lows, higher highs, higher lows, higher highs. Great, right? We've broken through one of the key resistance points. Right, let's move this guy up a little to capture that key resistance point. We've broken through one of the key resistance points, and all day long on the hourly, we've had green candles. So I'm technically expecting this trend to continue as long as we hold right above here and don't make a lower high, right? That's gonna turn things around. But until then, right, we can still continuously ride this EMA to the upside. So that's what we have to understand for structure, because structure in this qualifier is going to tell us, okay, like, should we lean to the long side, lean to the short side, right? So we're still leaning to the long side. Ever since we broke some of these resistance points somewhere here, we had to lean to the long side, right? We lean to the long side. These EMAs can help you as well. We have videos on that on our YouTube. But with the market structure, we have to understand higher lows, higher highs on a daily perspective, right? Start off with that. On the hourly, you get a better idea if you're day trading. I'm using a day trading example. If you're day trading, you get a better idea on the hourly. What is the trend like? Bullish, right? So we're going to continue on to the bull side. So step number 2, we're going to have to identify what our levels are. Now we can draw our levels starting on the daily. As a day trader, maybe you want to just focus on the hourly, more of the intricate moves. So why don't we just stick to the hourly here since we're already here, and we're going to identify areas of massive interest, right? Why that area that I just drew? Because it has multiple tests of this area, right, that failed aggressively here. Nice volume profile shelf. So that's what goes into identifying our levels. Volume profile ledges, massive failures, right? Same thing here. Nice double bottom holding support like a champion, right? So that's an area of interest. Another area of interest we could say can be somewhere here, right? Where we had the break of the prior resistance, right? Let's say somewhere here, we pulled back into it, right? You have a decent volume profile shelf somewhere in and around that area. That looks like a good level to trade off of. And then what we do is we continue with our multi-time frame analysis if we want to draw more levels. So as the 15-minute chart, for example, right, we should probably draw another level in between, because if we miss one of these levels, then we're left with no trades, right? So you can see very nice ledge here where the support resistance areas are, right? Very nice ledge here. Maybe we can drop it down a little to confirm some of these prior support resistances that we've seen on the prior day, right? And then what I do is after I've drawn these levels, we go to the 5-minute, and that's where we get busy. So we get busy on the 5-minute, right? After we've adjusted some of these levels, we make sure that we understand what we're doing with our levels. And then we get to the 5-minute. So part number 3 is going to be, right, volume. Can we qualify a trade based on volume? So we've had our market structure. We know we're on the bullish side, right? We know we're going to be looking for either pullbacks or just some kind of move to the upside. We know what our levels are, so if we pull back into those areas, right, great. And then number 3, we're going to be looking at volume, and we're also going to be looking at candlesticks as well. So there's 2 strategies that you can take in any market, right? Theoretically, if you've understood that the market structure is indeed bullish, then you're going to be looking for the long side, but you could also be looking to fade the market in key areas of resistance or support. So let's stick to the bull side, and we know that we're staying bullish because we're above all of the averages on a 15 and 5-minute, right? You can see there's a video on that as well, but that's a key rule of thumb. Can we maintain above our key support areas that we've drawn, right, based on our structure and our levels? Now, the second part is, can we actually hold those levels, right? Are those levels able to hold, right, as support resistance areas? As support in this case, because we've identified that the structure is indeed bullish. So if we break above and we pull back down, right, that's going to be a pullback. Can we hold those areas based on strong green candles and based on volume? That's going to be step number 3 and our third qualifier. So take this example here. Let's zoom in a little because we have a strong start to the day. And we get this nice pop on this 5-minute candle, right? We pull back down and we have a very strong, nice candle here. Volume's not that crazy. It was a little heavier before. We rally up and we get this pullback. Let's say we're waiting for this pullback. Now, with this qualifier, I meld together volume and the candles, right? How do the candles actually form? The more rotations in the area, the better for me, right? They're riding the averages. They're holding the support structure. We have nice wicks. When we have a lot of wicks into a support area or a lot of wicks into a resistance, that starts to confirm the area for me because there's sharp buyers each time that you press that level. That's the key. You come down, okay, great, but sharp buyers push it back up, push it back up, push it back up. And in some cases, right, on heavier, solid green volume that's coming. It's not the craziest, right? But this is where I'm really sold because, okay, this candle was thicker, right? Heavier, nice wick, which is not necessarily very bearish. Decent volume, the candle after that, green, but the volume isn't as big. So I'm like, you know what, maybe. And then this candle comes in with a wick. They try it, the bulls try it, but the volume is very, very light. At that point, I know, okay, well, with these wicks, they're still trying it. I can look for an entry on whether it's SPY, whether it's calls, whether it's the futures, whatever it is, into these wicks for the long side, right? I'm confirming the structure. I've confirmed my levels. I've confirmed now with volume and some candlesticks that I can have this trade. And then the fourth part is, right, the risk management aspect, right? The risk management aspect is, can I limit my risk by placing it under a key support area? And is my upside greater than what my downside might be? My upside is theoretically going to be back into these tops. That's where the next big resistance is. You can see that massive failure on a very strong wick, right? That's where I expect price to fail again, and it does. And my downside is limited to probably just below this level. So if I'm getting in somewhere 438.65. My risk could be about 40, 50 cents, right? And the upside potential is about, you can say maybe $1.80 to $2 and something, right? That's my upside potential. So it's the risk to reward is there. That means I've qualified it. I've understood what my risks are. I take the trade if it all is logically sound. Now let's look at this very similar example on Airbnb. So Airbnb, we have our levels, right? We go, number one, market structure. What is the structure of this thing, right? How can it change structure? Number two, where are our levels? Number three, candlesticks and volumes to qualify it, right? Number four is the risk there to be managed. So let's go to the daily. We'll start with the daily here. And this is why I really liked Airbnb, because it's been consolidating fairly well, right? Some can argue it's in a bear market, but right now, what we're seeing is we're seeing a consolidative period here with multiple tests of a key resistance. So we draw our levels. We know above, realistically, where the big ledges, where this resistance is, above this area, 160, right? These other areas are good, but above the 160, we really open things up into the next volume profile distribution. We have a video on volume profile distributions if you guys don't really understand what they are, but this outlines that if we break 160, we theoretically should be somewhere in the midpoint of this volume profile. That's going to be our target, around 167, 168. An $8 move in options, for example, is a very lucrative move. So let's break this down. We already have our levels drawn out here, right? We just have to break down what had happened throughout the day. So we have our levels, right? Everything is assumed to be drawn out. We can go to the hourly and confirm. We know what our trend is on the hourly, right? Bullish, we're riding the EMAs, higher highs, higher lows, so we want to continue the bull. We know where the key resistance break is going to be, 160. When we go to the 15-minute, maybe we draw some more levels, right? Fine, whatever. And then you can see where the volume profile ledges are. We might have a other level at 158, right? Maybe you get the trade even earlier. And then we go to the 5-minute and start our qualification process. So even with the 158, it breaks, right? Fine, off the open, but it doesn't close. I want a candle close above the area. This one closes, great, starts to rotate. Honestly, at this point, we're looking for even like slight minor pullbacks into some of these averages or just the close above the area. Once we start moving above these wicks, right? Maybe we get that move because look what happens. On the volume side, right? This is more of a breakout trade. You could wait for the pullback that comes much later in the day. Based on this volume profile, you can see where it is. But look, we get a huge candle to start. Increasing volume, and then all of a sudden, this little green candle, this is why volume is very important. This little green candle, right? Right at the resistance of 160, that's gonna be a big threshold. Look at the volume on this guy. At that point, my risk is buying it in and around that area once we start breaking through the 160. That's my risk, right? Even if I wait for this red candle to shape up, look at the volume. It's sad in comparison to this one. Look how small it is. He can't even see between his little neighbors here. He's depressed. So what I want to see is take over those wicks, or I'm just getting in right after this candle closes and risking, right? I could risk even down below here as a new low. So it is a sizable risk because I'm going let's say 159. Let's say for argument's sake, 160 all the way down into 158. So I'm risking $2 theoretically. But remember where our distribution area was, 168. So I'm risking $2 for $8 of a move. It's worth it, 4-to-1, right? Or I could risk under a few of these candles and you can go to a different time frame for that, like a 3-minute or something, and say, you know what, like under these candles somewhere here, I might just cut my risk. We get the move, right? It happens. Maybe you miss it and you say, no, I want to wait for a pullback, a better pullback. Where can it pull back into the volume profile ledge, right? Or the moving average, right? The moving average here, what is volume doing? It starts to pick up on the bull side, right? Very nice candle here. You pick up some of the longs, stops below these lows. So you're getting long 163.80, let's say. Your stop is 162.80, $1, right? Upside is somewhere where these resistances were, 166. Perfect, right? Your risk to reward makes sense, take the trade. So with these very simple qualifiers that we ran through, market structure, understanding the trend and understanding how the trend turns bullish or bearish. We have levels. Levels are super key, as you guys saw. Volume profiles, key points of inflection where price can actually make a move through, right? Or against. Then we have volume and the candlesticks, mainly volume as a big qualifier, right? You saw how that worked multiple times. No matter what you take, it's going to be the same thing. It's going to give you a glimpse as to what you should be doing. And then number 4, does the risk make sense? Am I willing to risk this much for this reward? And it's key to stay on trend. If you're going against the trend, the risk to reward will be skewed. Keep that in mind. So with that, we've found 4 simple qualifiers, and the only 4 qualifiers that you need to be focused on as a newer trader, right? As a trader that may have seen this before, it's a great reminder. So I really hope you guys enjoyed this video. Thank you for watching. There's more videos like this on the way if you guys just drop comments of what you guys want to see. We'll see you guys next time. This is Victoria from TRADEPRO Academy. Hope everyone has an amazing weekend, and don't forget to hit that like button, smash that subscribe button, and ring that bell to notify you when we do go live. Thank you, and take care, everyone.